A hearty welcome. Thanks for everyone support on our MBA Decoded 100. A hearty welcome to the subscribers as well as for the watchers for the new lesson on capital budgeting. Everyone know mobilizing the funds, it's not an easy task. But once the company is able to mobilize the funds from different sources, it is equally important to employ that funds on various assets on the basis of priorities. We'll be considering many factors, risk, return, and we'll have a minimum expected return also to meet out the financial obligations. Cash flows, the benefit, how much you're going to get from the asset, that also plays a major role. And in this chapter, we'll be discussing about the capital budgeting, what are the different types of capital budgeting techniques used by the firm. And before starting the chapter, let me recollect the simple mechanism behind choosing of an assets. Assets will be productive. The productiveness will be measured in terms of cash flow, the volume of benefits what you're going to obtain from the machinery or any building or anything. So this will help you to understand the basic information like cash flow, benefits what you're going to get from the investments. So investments versus benefits, that can be a basic parameter. We have already discussed about the need for capital budgeting. Capital budgeting is the managerial technique of planning capital expenditure. When we are pinpointing the term capital expenditure, they are huge in nature, irreversible. If you buy a machinery which is having a lifespan of 7 years, so you cannot reverse it for next 7 years. It involves huge money. Please remember that money is not your money. That money borrowed from somebody else. You have to pay interest, you have to repay the principal amount. So capital expenditure, you'll be using it effectively, the combination of various assets with overall goals of the company. The capital budgeting that examines the viability of an investment project with the help of demand supply analysis. And simple, the demand refers to the investment opportunities of projects. Supply is nothing but wherever the funds are available as per your terms, by balancing both risk and return. The investment opportunities are evaluated in terms of net cash flows over the life of projects. How much per year, how much money per year that particular asset is going to generate. If it is a machinery production can be monetized. So that's called cash flow. We used to say expected cash flow. Capital budgeting techniques are broadly classified into two types. One, discounted cash flow techniques, another one, non-discounted cash flow techniques. And the discounted cash flow, we'll be considering the discount factor. So if you have 1 rupee, that's not going to be 1 rupee after a year. After 2 years, the value will be declining. So we'll be applying the discounted cash flow to bring the future value into the future value into the current value. So in this case, a discounted cash flow techniques, we have four methods. One is net present value, popularly known as NPV. Another one IRR, internal rate of return. And third one, profitability index. And fourth one, discounted payback period. It's just an extension of payback period, discounted payback period. And coming to the second major category of non-discounted cash flow techniques, we have payback period and accounting rate of return, ARR method. So please remember NPV, net present value, IRR, profitability index, payback, discounted payback, and ARR. These are the different techniques which are coming under capital budgeting. Let me start with the first category, discounted cash flow techniques. The present value are discounted cash flow techniques. Process recognize that cash flow streams in different time period differ in value and can be compared only when they are expressed in terms of a common denominator, which is known as present value. In this, take into account the time value of money. So time value of money is given the importance in the case of discounted cash flow, whereas non-discounted cash flow will not give importance for the time value of money. So the value of money differ. Say if you have some money, the value of that money is going to be different after 1 year, 2 years, like that. So we give consideration for that time value of money. That plays a major role in case of discounted cash flow. As you are aware, net present value method is coming under discounted cash flow method. NPV is a method used in capital budgeting to determine value of an investment or a project. It is a difference between the present value of cash inflows and outflows over a period of time. How much cash which is going as an outflow, which is nothing but the original investment what you have made at the time of procuring the particular asset. The asset may be a machinery or a building or any other thing. So you'll be comparing the outflow with inflow, the present value. So automatically, with the help of that one, you're able to calculate the present value. See, the formula what we are using it is very simple. Net present value. We'll consider few important things. N always the expected life of an investment. Say it may be 6 years, 5 years, 4 years, depending upon the assets capacity. And T stands for duration, the time during which cash flows is expected to occur, and of course the net cash inflow. What you are going to get it? That one C1, C2, C3. If it is a 3 years, we'll be repeating for 3 years, C2, C3, like that. If it is for 5 years, we'll be go for C1, C2, C3, C4. K is nothing but opportunity cost of capital, and very important, okay, the CO stands for initial investment. It's very simple. First portion you can look into that, C1 divided by 1 plus K to the power T. That represent cash inflows, how much money you are getting from the asset. CO stands for how much amount of initial amount you have made it. Say for example, as per this formula, just for a better interpretation, the CO, you have made an investment of 10 lakh rupee. Suppose the C1 divided by 1 plus K to the power T, the computed value is, the cash inflow is coming around 12 lakhs. So 12 lakhs minus 10 lakhs. So you are getting a plus 2 lakh rupee. So the net present value is positive. So whatever the money you invested, you are able to get it 2 lakh rupee extra. If any investment, if you are able to get 4 lakhs extra, say for example 14 lakhs or 15 lakhs. So 15 lakhs is to be the better present value. Likewise, we'll be assessing it. I think now we'll get a clear idea about the formula. It's simple thing, how much cash inflow you are getting and how much cash outflow you have already made. Okay, that's the difference we are going to identify. The difference is said to be the present value. Okay, once you are able to compute the cash inflow and outflow and substituting the values in the formula, you'll be getting the final results of net present value. How we're going to decision based on the computed values. So here NPV decision rule. It's very simple. The decision rule under NPV is used to accept or reject the project. Say for example, if NPV, net present value, is greater than 0, accept it. That's positive. We are given an example, okay, 15 lakhs you got it, okay, through cash inflow, outflow you have made 10 lakh rupee, difference is 5 lakh. So that will lead to a positive impact in that. The first case, NPV is greater than 0, you can accept it. Suppose the investment what you have made in procuring a machinery is 10 lakh, but now cash flow you have received only 8 lakh rupee. That will lead to a difference of negative 2 lakh rupee. So when NPV is less than 0, that's negative, you can reject the project. So thumb rule, please remember, when NPV is greater than 0, accept it. A project is good. When NPV is lesser than 0, negative, okay, you can strongly reject that project. Dear students, okay, now it's a time to take your notebook. Okay, you can follow my classes by doing a simultaneous calculation in your notebook too. And the formulae and the decision making criterion we have discussed. Now we are going to try with a simple problem. Say for example, if you want to invest 1 lakh in a project. Okay, if you make an investment of 1 lakh, the project will give you returns of 40,000 at the end of first year. At the end of second year, again 40,000, and at the end of third year, 40,000. The discount rate is 10%. We are supposed to calculate net present value. I think net present value, okay, just recollect the formula here. You can write it. Okay, you see here N stands for yes, T stands for okay, and C1 stands for cash inflow. Correct, you are correct. 1 plus K, yeah, the opportunity cost K and to the power yes, minus yes, you are correct. That's an initial investment made by the company, which is known as cash outflow. Great. So you can also respond to my questions too, please. You can start doing the problem along with me. Now, as far as this particular problem is concerned, the initial investment is made by you is 1 lakh rupee, and it's clearly given. First year 40,000, second year 40,000, third year 40,000. That's a cash inflow expected. Discount rate is given in the problem itself as 10%. Now, let me calculate the present value of cash flow. So, I want to calculate the present value. So, for the first year. So, first year how much we are getting? Just recollect the formula. The second portion C1 divided by 1 plus K to the power T minus cash outflow. So 40,000 is an inflow. C1 is nothing but a cash inflow during the first year. Second year, look into the second year, 40,000 again. Third year also 40,000. So 1 plus K. 1 plus K is nothing but K is 10% given in the problem. If you convert that one into decimal, 0.10. So first year 40,000 divided by 1 plus 0.10 to the power 1 first year. So likewise, if you look into the second one, 40,000 divided by 1 plus 0.10 to the power 2 because second year. Likewise, present value for the third year, 40,000 divided by 1 plus 0.10 to the power 3. If you look into the value, 40,000, it has become 36,363. Likewise, during the second year, what you are getting in the 40,000 what you have made, the received, that is 33,057.85. And third year, the money what you have generated, the 40,000 has become 30,052 rupees 0.07. So now we computed the present values of first year, second year, third year. We are going to make a cumulative value adding all these three, and we are going to compare with the initial investment of 1 lakh. Hope you are also doing continuously along with me. So step 3, total present value of inflow we have to calculate. Just add first year, second year, third year, the computed net present value. If you add all 3 years, we are able to get 99,473.56. What the basic idea behind the formula? We'll be comparing both value of inflow and outflow. First take the inflow total value during 3 years. 99,473.56 minus the original investment made. That's nothing but cash outflow 1 lakh. We are able to see the difference minus 526 rupee 0.44. So the net present value is negative 526.44. So how we are going to interpret? I think now you can recollect the accept or reject criteria. Can anyone able to recollect? Yes. When NPV, yeah, great. So we'll be taking positive, negative. Okay, if it is positive, okay, we'll be accepting that project. If it is negative, we'll be rejecting the project. So now based on the computation, we are going for an interpretation. Since the NPV is negative, the project is expected to lose 526.44 rupees in today's terms and might not be a good investment at 10% discount rate, because project must be in a position to generate more than what you invest. So as far as the net present value is concerned, this project we cannot consider, so rejected. Hope I think you will understand the entire concept of the simple problem. Okay, wait, we'll be going for one more advanced problem which will tell you the entire story of decision making criterion. So don't look into these type of problem as only for examination point of view. These are all the things will improve your decision making skills, problem solving ability and strategic thinking also required. So I think the subsequent problem will be a good problem. I'm going with the little advanced input on that. I think everyone geared up for the next problem. The first one is very simple, easy to understand too. The Romtech Solutions Private Limited is considering launching a new smart home device. So the initial investment required is 2,50,000 rupees. Yes, this is called cash outflow, we used to say, CO. What is needed? We need a cash inflow over the period of time. Here 3 years are given. The expected cash flow during the first year is given 1 lakh, second year 1,20,000, third year again 1 lakh. The company uses a discount rate of 12% to evaluate the projects. Last problem we had a 10%, we had a decimal value of 0.10. Here we have to go for 0.12. You are requested to assess the new project viability based on net present value. Since you have done the first problem, this problem will be very simple to you. So the initial investment made by the company is given, okay, 2 lakh rupee. Is it correct? 2 lakh rupee. Yeah, just recollect. No, the money, okay, invested by the company is 2,50,000 rupees. Good. I think one person is able to recollect. And coming to the first year, able to generate the cash inflow of 1 lakh rupee, second year 1,20,000 and 1 lakh again during third year. And this is a cash flow. Just we are going to convert the present value. First year, second year, third year, we are taking the cash flow as a base 1 lakh, 1,20,000, 1 lakh divided by 1 plus 0.12 because the rate is given as 12%. So to the power 1, to the power 2, to the power 3. If you go for a simplification, you are able to get during the first year 89,285.71. Whereas during the second year, you are able to get 95,674.30. During third year, you are able to get 71,200.14. Okay, as you know, we are going to add all these three. The present value during first year, second year, third year will be accumulated, and that will be compared with the cash outflow. That's the original investment made by the company. 2,50,000. So 2,50,000 versus the cumulative value of net present value. Okay, let me calculate. I request everyone you can add all these three values and tell me how much you are able to obtain. Now you can continue your calculations to calculate total present value of inflows. It's clearly given, or add all the values obtained for last 3 years. The 3 years given. First year, yeah, we already computed 89,000 to 85.71. Second year, 95, 674.30. Third year, 71,200.14. Total 2,56,160.15 paise you were getting. So what do you do with that? In net present value, we'll be comparing the inflow with the outflow. Outflow is nothing but initial investment. Total present value of inflow minus initial investments. So net present value is 2,56,160.15 paise as per our calculations. The original investment 2,50,000 is given in the problem. Difference is 6,160.15 paise. So how we will take a decision? Look into the criterion. Since net present value is greater than 0, the project is expected to add value. Okay, it's positive. The project is financially viable and should be accepted. So when the NPV value is greater than 0, so we'll be accepting the project. That will be coming into the positive. If it is not so, it will be rejected. As far as this problem is concerned, it's positive. So we are accepting the project. Yes, good. I think the people, those who are following me, I think it'll be easy for you to understand the concepts and practical applicability of the same. Hope everyone able to understand about net present value method. IRR just is an extension of net present value. We'll give importance for net present value also here. The internal rate of return or a method is a financial technique used to estimate the profitability of an investment. By finding the discount rate at which the present value, that is NPV, of all cash flows, both incoming and outcoming, equals 0. It is a useful technique for capital budgeting and investment analysis because it shows the potential rate of return of an investment with a higher IRR, generally indicating a more attractive investments. To calculate the IRR, you set the NPV formula to 0 and solve for the rate, which is often done using a trial and error process or with software like Microsoft Excel. I think now we got a clear idea that's clearly given. Okay, the IRR is the discount rate that makes the net present value of a project equal to 0. In other words, it is the rate at which the present value of cash inflows equals the initial investments. We used to say break even point. Likewise, you can take, just remember, okay, the break even point. So where you are able to get back the original investment. It tells you the expected rate of return of a project. And we had a different technique. If it is a positive, accept in the case of net present value. If it is a negative, reject. Here, in the case of internal rate of return, the accept and reject criteria, how we are going to do it? If the internal rate of return is greater than required rate of return, accept the project. It is profitable. That means it's a profitable project. If internal rate of return is lesser than the required rate of return, reject the project because the project is said to be not profitable. I think you will understand here. ARR must be greater than required rate of return. You can accept and you can reject in case if IRR is lesser than required rate of return. Very simple to remember and also to recollect. Dear students, now let me look into the formula. I think it's going to be very easy because already we have discussed about net present value. This formula, the first portion is similar to net present value. We will be taking as such. You can see all the values. Okay, Here the small r represent internal rate of return. All other things are similar. Only thing is, I think you recollect the basic condition we have mentioned in the earlier slide. Internal rate of return is the discount rate that makes the NPV of a project equal to 0. That's why we put equal to 0 in this formula. I told you it's just an extension of net present value. Now, as per the condition, okay, the NPV of a project equal to 0. That's a condition. So we put equal to 0. The same formula, just we are making equal to 0. And please recollect, the IRR is greater than required rate of return, then you will consider the project. If it is not so, if IRR is lesser than the required rate of return, we'll be rejecting it. Let me try with a simple problem to understand how the computational procedures will be followed. Are you ready? Thank you for your positive response. Let me proceed. The Bright Tech Limited is looking for a new software development which require an initial investment of 1 lakh rupee. The cash inflow expected first year 50,000, second year 60,000. The required rate of return 10%. You are supposed to evaluate the project with internal rate of return. Just to recollect the formula, okay, it's the same formula what we've used for NPV. Now we are putting equal to 0. Okay, get ready. We'll do a working of this problem. So remember, original investment 1 lakh rupee, expected cash inflow, yes, 50,000 during first year. How much amount of money during second year? Yes, exactly 60,000. A required rate of return 0.10, 10%. Good. Let me proceed with the problem. Students, now we are going to calculate IRR. What is the base? NPV. See, we'll be using trial and error or a financial calculator. You can use it as per your convenient. In this problem, it's given us 10% discount rate. So based on that, we are going to calculate NPV. See, the first year we got a cash flow 50,000, second year 60,000. We are substituting the value 50,000 divided by 1 plus 0.10 to the power 1 plus 60,000 whole divided by 1 plus 0.10 to the power 2 minus cash outflow. Yeah, the original investment, initial investment made 1 lakh rupee. So net present value. Okay, if you go for a simplification, the difference is negative minus 8,958.67 paise. So now you can see the at the rate of 10%, the NPV is negative. So we have to try with the other different rates. Now we are going to try with 8% or 5%. 9%, anything you can go for it, because at the rate of 10% it's negative. You can go with the lesser rate of lesser rate, less than 10%. Okay, we are going to try with 5% and 8%. Let me see how the results are going to be. So net present value same. Okay, I'm going for the substituting the value. Only thing is 10%. Now I'm replacing with the 8%. So same cash flow 50,000 divided by, yes, 1 plus, yes, 0.08. Correct. Great. So second year 60,000 divided by 1 plus, yes, 0.08 to the power 2. Yeah, you are substituting the value, you are getting again negative minus 4,263.37. Now please compare the first result. The first one also you find the negative amount minus 8,958.67 paise. Here also minus 4,263.37. So here also at the rate of 8%, it shows a negative impact. So still negative. we are going to further revising the rate from 8 to 5 by reducing 3%. So now I'm going to substitute the value. Again, you take it 1 plus 0.05 to the power 1. So 50,000 divided by 1 plus 0.05 to the power 1 plus 60,000. You can also do it. Yeah, good. You can also follow my steps. 60,000 divided by 1 plus 0.05 to the power 2. Initial investment minus 1 lakh. So if you simplify, you are able to get 1,02,040.82 minus 1 lakh rupee. So now we are able to get a positive result on that. So here you can look at that, become minus 2, it has become positive. So you can easily understand that the internal rate of return lies between 5% and 8%. 5% and 8%. So 10 is 10, it's negative, 8% also negative. But when it is coming below, we are able to find it. So IRR is approximately between 5% and 8%, which is less than the required rate of 10%. So how will you take a decision? As far as this case is concerned, they given only 10%. So reject the project since the internal rate of return is less than 10%. 10% is nothing but, yes, the required rate of return. So you cannot consider this particular project. I'll recap simply. First we tried with the 10% actual value given in the problem. Okay, it resulted in negative of 8,000 and we further reduced to 8%. When we tried with the 8%, it was again negative minus 4,000 and when we went for a 5% rate, that time resulted in a positive way. Since this problem adhered to 10%, 10% result in negative, we cannot accept this project. I think now we got a clear-cut idea. Okay, I'm able to see many people are able to complete it on time. So I think once you are able to understand the NPV, this is an extension. IRR is just an extension of that one. Okay, good. I think many people are able to follow and complete the problem on time. Let me move on. Let me add some difficulties to the existing problem and let me proceed further. This is going to be a excellent exercise for you. I think you were also eagerly waiting for a much more better problem than the initial illustrations. Here you can take this case as a Greenleaf Cafe. It's a small coffee shop that wants to purchase. They are willing to purchase a new espresso machine to attract more customers and increase the sales. If you look into the initial investment required to procure that espresso machine is 8 lakh rupee and project life expected is 4 years and salvage value is 80,000 rupees. Salvage value is very simple. At the end of the 4th year, so the expected life span of the machine is 4 years. At the end of the 4 year, so first initially you were investing 8 lakh rupee. At the end of the 4th year, the old machine, what the used machine for the last 4 years, that can be sold out in the open market for 80,000 rupees. That's called salvage value. Okay, and it called in different ways also residual value, salvage value, and other thing. So very simple. So 8 lakh rupee. So you are going to get a 80,000 at the end of the year. So we'll be adjusting that 80,000. I'll come later. So required rate of return 10%. 10% expected cash flow are given below. First year you are spending 8 lakh rupee. Okay, cash outflow or initial investment you can take it. Extra profit from Better Coffee because of that investment, 2,80,000 during the first year, then 3,20,000 during the second year, 3,60,000 during third year, and fourth year you got extra profit, 2,40,000 plus the machine residual value 80,000. Total benefits you obtain 3,20,000. This is a simple problem. Now you have to apply IRR method, and you have to take a decision, okay, whether the purchase of this particular espresso machine is advisable or not. I think students, I think this is going to be a good problem. Let me do it, quicker. All the best. Get ready. I think most of the people are ready with their with your pen. Let me start with the stage one, step one. Yes, students, get ready. You can try along with me. This is going to be a first trial. Let me try at 15%. Okay, let me try with the 15%. See here, the cash flow already given in the problem. Initial investment is 8 lakhs, so the amount is put in within the bracket. That means minus 8 lakh rupee. And at the end of the first year, 2 lakh 80,000. Second year, 3 lakh 20,000. Third year, 3 lakh 60,000, and fourth year, 3 lakh 20,000 respectively. We'll go for it computation 0.15. Yeah, see the formula you'll recollect. We'll be putting cash flow. So 2 lakh 80,000 whole divided by 1 plus k to the power t. So 1 plus k is nothing but 0.15 to the power 1. Likewise, we'll be going for a power 2, power 3, power 4. If you go for it, the computed value of the present value is amounting to 1 lakh 5,189. What do you do? The present value will be compared with the amount originally invested. So just we are comparing it, we are able to see, okay, it's a positive, but it's not sufficient. See, yeah, this means 15% is too low. We are still making money, so IRR must be higher. So let me go for try different rates. So let me go for different rates. We'll continue the same thing. We'll try with different rates, because we test different rates to see which one makes NPV as 0. Yeah, the trial 2 we are going to try with 20%. You can see the result also. Here you look into the same thing. We are applying it. You look into the formula, the calculation, 2,80,000 the first year, divided by 1 plus k to the power t. So 1 plus k is nothing but 0.20 to the power 1. So likewise, second year, third year, fourth year is also calculated. And the total NPV is now we can see 18,209. So it has increased. Okay, as far as the first case, that was very meager when we applied, when we applied 15%, now 20. Okay, it has yielded 18,209. Okay, now let me try with the different, higher rate. So we have tried up to 20 now. Let me try with the higher rate now. As students, now we are going to try with 22%. What the result we are going to obtain, the same thing you repeat, only one replacement we are going to do it. 0.22 in each year we are going to replace. So it's going to be a very simple cash flow. You take fourth year 3,20,000 divided by 1 plus k is here 0.22 to the power 4. Yeah. Now look into the value. At the rate of 22%, it went on negative of 13,035. I think now it's quite interesting. Now we have to look into that very seriously. Now we'll go for a consolidation to how to interpret the results. If you're a student, I think the first problem is sufficient, more than sufficient for your examination point of view. But this problem will give a real-time experience, decision making, particularly when you are going to the company, these type of circumstances will arise. Let me see how to consolidate the observations. Let me go for a final consolidation of results now. We know IRR is between 20 to 22%, but now we have to identify the exact value. So in the corporate, they'll be taking decision based on interpretation only. So as a manager, budding managers, finance managers, you must be in a position to take decisions too. So what do? IRR is equal to lower rate plus NPV at lower rate divided by difference in NPVs into difference in rates. This is a formula we'll be using. Its IRR is 20% plus how much benefit you obtained? 18,209 positive plus 18,000 all divided by, we have to find the difference. So again I'm putting 18,209 minus of minus 13,035. So that's a difference in 22 percentage at the rate of 22. So it's going to be 18,209 minus of minus 13,000. So once you become minus of minus, it will become plus. That's why in the next line it was added 20% plus 18,209 whole divided by 31,244 into the difference in rates. That's 22% minus 20%. That result in 2 percentage. IRR is equal to 20% plus 0.5828 into 2%. Further simplification that leads to 20% plus 1.17 percentage. So IRR, the final results we are getting 21.17. So the IRR for the espresso machine project is 21.17%. Now we got the answer 21.17%. But what does this mean? Yeah, you must be in a position to understand that one. Buying the espresso machine is likely putting money in a bank account that pays 21.17%. If you put that initial investment in the bank, that amount must be in a position to yield 21.17% interest per year for consecutively for 4 years. So Greenleaf Cafe buy it? Yes, of course the decision is yes, positive. Okay, they can buy it. Comparison, as I already told you, IRR 21.17%, internal rate of return we have computed, required return 10% only, and the extra benefit. The company expected only 10%, but internal rate of return is 21.17. So this particular machine is able to yield 11.17% extra benefit. Since 21.17 is much higher than the 10% minimum the cafe needs, this is an excellent investment. So let me apply the decision rule. Easy to remember. I think we have already discussed. When IRR is greater than required rate, accept it. Good investment. Now the required rate is only 10%, whereas IRR we have calculated, internal rate of return is 21.17. So strongly recommend for the project. Okay, you may have one question: when IRR is equal to required rate, okay, in difference. Okay, just a break even. That's a thing, okay, you learn from this. Now let me think about real world interpretation. Okay, we now what 21.17 internal rate of return means for Greenleaf Cafe. Let me go for a further invading. As I already told you, it's like a case study. The one is better than alternatives. You may think about alternative, but no one will give 21.17. This is much more better. When your expected yield is only 10%. And you have a strong safety margin. What you expected is only 10%, but you are able to get 11.17% additionally. That has given a total yield of 21.17. And that means a quick payback. The high return means the cafe gets its money back faster and creates value. For every $1 invested, the cafe makes much more than $1 back in present value terms. And if you're a beginner, I can tell you in a colloquial way, the internal rate of return is the break-even interest rate for an investment. I already told you in the initial stage of the presentation. Higher internal rate of return is the better investment. And compare IRR to record return to make decisions. You must be in a position to compare IRR with the record rate of return to take decisions. When internal rate of return is greater than required rate, accept the project. What we did, as far as this green leaf cafe is concerned. The bigger the difference, the safer the investment. I think this particular problem will give you the entire story about understanding the net present value, IRR at a different level, okay, how we are going to fix the trial and error values, and how we are going to find it. I think this is one of the fruitful problem. I think you're also done a good work. I think everyone follow the footprints. I think I'm able to see many calculations in your notebook too. Good luck. Let me discuss about profitability index. The profitability index compares the expected cash flow from a project with its initial cost. The profitability index is known as value investment ratio VIR or profit investment ratio PIR. You can remember VIR and PIR, which represent the relations between cost and benefit of a proposed project. The formula, what you are going to use it, profitability index, that is equal to present value of future cash flows divided by initial investment. Say for example, if you make an interpretation, PI of 1.25 means for every 1 rupee invested, you get 1.25 back in present value terms. Higher the PI, more efficient use of capital. So if the PI is more than 1, you can accept. If PI is less than 1, you can reject. I think student, you will understand the importance of profitability index. Yes, student, let me have a simple example for profitability index calculation. Say for example, initial investment made in a particular project is 5 lakh, and you are supposed to calculate the profitability index. The particular investment is able to yield a net cash flow of 1,50,000, 1,70,000, 1,90,000, 1,50,000, 1,80,000 for consecutive 5 years. And we have to bring that value, net cash flow value, to the present value by multiplying with the PV factor at 12%. See here the PV factor value. See what you are seeing here, 0.8929, 0.7972. You can refer to the textbook of any financial management or corporate finance. PV factor value will be given at the end. You can refer that one, you can get it. It will be given at the different percentage at 10%, 12%, 15%. As far as this problem is concerned, it's given as 12%. Initial investment 5 lakh. So just take the net cash flow. You can see the first column stand for year, second column net cash flow. Hope you are also working out the problem along with me. See, just you can write the net cash flow every year and PV factor. Sometime it may be given in the question paper itself. Otherwise, you must memorize these 5 to 6 values. And we are multiplying it. By multiplying the net cash flow with the PV factor, we are able to get the present value. So the total computed present value is 6,02,158, whereas the original investment is 5 lakh. What's the formula for profitability index? PV of present value of cash inflow divided by initial investment PI. Initial investment, you calculate PI. So very simple, 6,02,158 whole divided by 5 lakh rupee. So you are able to get PI 1.204. So profitability index, how much you obtain? Yes, 1.204. Good. So the criterion, if the PI is greater than 1, you can accept. So decision, what you are going to take for this investment? Yes, you will accept. How are we going to interpret? For every 1 rupee invested, the project returns 1.20 in the present value terms, which creates 0.20 value per rupee invested. The project adds value of 1,02,158 net present value to the firm. I think you might have obtained a clear-cut idea about the profitability index computation. The next method is discounted payback period. We already discussed payback period in another video. Payback period, it's very simple. Original investment divided by cash flow, annual cash flow. So now, okay, we'll be having a discount element also while calculating payback period. Let me take a simple example for it. Say for example, we have projects. See here in this example, we have two projects. Let me have a discussion about the first project. Initial investment made 1,20,000 rupees. Discount rate 10%. I think the last problem we have taken the present value factor at 12% we have taken. At this problem the PV discount rate is given at 10%. So you have to refer the table. Normally it will be given as a 10% only. You take it. The cash flows are given. Initial investment we have made 1,20,000 rupees. And first year the cash flow is 48,000, second year 50,000, third year 40,000 and fourth year 39,000. Let me go for a cumulative value. And for each year cash flow we have to multiply with a PV factor at 10%. See, please remember only cash flow will be taken, not a cumulative value. So 48,000 in the first year, that will be multiplied with the PV factor at 10%, that is 0.9091 will become 43,636.80. Likewise, second year 50,000 multiplied with 0.8264, that will become 41,320. Third year 40,000 multiplied with 0.7513 resulted in 30,052. And fourth year 39,000 multiplied with the present value factor of 0.6830 resulted in 26,637. So this is called discounted cash flow. Now we have to go for cumulative value for a discounted cash flow too. If you put a cumulative value, okay, now we got the values. One we have taken a plain payback cumulative, another one discounted cumulative value. And payback period is the number of years before full recovery plus unrecovered amount at the starting of the year divided by cash flow during the year. See here, and how many years it take to recover? Original investment is 1,20,000. So 1,20,000. So 2 year number of years before full recovery is a 2 year, and in the third year 22,000 in the third year whole divided by how much bracket? The balance amount 40,000. So it will result in 2.55 years. Okay. And a discounted payback period, it's already we have calculated. So here number of years before full recovery, that's 3 years plus the computed value for the third year 4,991.20 whole divided by how much to be recovered? 26,637. That is equal to 3.19. Similarly, we'll have one more project, let me see. Then we'll go for a comparative result analysis too. Let me think about one more project, similar project like that. Project B. Here initial investment 50,000, cost of capital 10%. So the cash flow is given, initial investment during the first year, outflow is 50,000. So we put minus 50,000. Cash flow during various during first 5 years 13,500 each, second year also 13,500, third year 13,500, continue up to fifth year. Now to calculate the normal payback period, we'll go for a cumulative value of cash flow. So 50,000, just we are adjusting. First year 13,500 adjusted, balance is 36,500, and likewise 13,500 adjusted, 23,000. Subsequently again during the third year 13,500, that amounting to the amount of minus 9,500. And if you look into the fourth year, fourth year 13,500, the 4,000 rupee, it has become positive now. So what you are going to do with that? It's going to be net investment divided by annual cash flow, you know very well. So 50,000 that was invested divided by 13,500. So the computed value we are getting 3.7 years. That means 3 years plus 7 months that required to get back the original investment. So payback period. And coming to the discounted payback period, we will be having a PV factor at 10%. So you have to refer to the table value. First year it's 0.9091, 0.8264, 0.7513, 0.683, 0.6209. This is for all 5 years. Now we have to multiply with the we have to go for a discounted a cash flow. So multiply the factor with the amount. Say for example you got 13,500, that should be multiplied with 0.9091. We'll get 12,272, and second year 11,156, and third year 10,142, fourth year 4,000 into 13,500 into 0.683, 9,220, and you'll be getting in the final year 13,500 into table value of 0.6209. You are able to obtain 8,382.15. Now as usual you go for a cumulative value. If you look into the cumulative value, okay, direct payback period we are able to get it within 3.7 years. But here look into the value even after fourth year, the value cumulative discounted cash flow stands in minus 7,207. So you have to wait, you have to go beyond 4 years. That's a thing. Okay, if you apply the formula, okay, the number of years before full recovery plus unrecovered discounted amount in the start of the year divided by discounted cash flow during the year. So how much to be recovered and how much cash flow during the year. So cash flow during the year is 7,207 and money to be recovered is 8,382.15. So final amount, the discounted payback period is 4.85. So we had two projects, project A and B. Now let me discuss about this one, how we're going to finalize the thing. So two variables we have utilized. One is payback period, another one discounted payback period. Payback period 2.55 years in project A, whereas project B is 3.7 years. Very simple. I would wait for 3.7 years in case of project B, whereas in the case of project A, I'm able to get the result, get back the original investment in 2.55 years. And coming to the discounted payback period, 3.91 in case of A, whereas 4.85 in the case of B. Students, tell me, what is the criteria to select the project under payback period or discounted payback period? Anyone? Yes, exactly. Lesser the payback period, better the project. Yeah, we already discussed in the last video. So from the above result, we can see that the discounted payback period is higher than the payback period because it consider the discounted cash flow for determining duration of recovering initial investment of a project. Good. I think now we were able to understand both payback period as well as discounted payback period. Good. Let me pass on to the next topic. Yes, the second major category is non-discounted cash flow techniques. As you are aware, we have two different methods under this payback period. Just now we have discussed elaborately. Another one, ARR, accounting rate of return. So two techniques are coming under non-discounted cash flow technique. First, let me discuss about the payback period. Since we have discussed plenty of thing about the payback period, we had two projects A and B. I'm not going to spend much more time here. Simply a formula recollection. Payback period, how will you calculate? Anyone? Yes. You'll be taking initial investment as a base and divided by annual cash flow. Excellent. So accept shorter the payback period, better the project. Good. Let me discuss about the last method which is coming under non-discounted cash flow. It's none other than ARR, accounting rate of return. See, average annual accounting profit as a percentage of initial or average investment we used to do under ARR. The formula, it's very simple. Average annual profit. So earlier we used to mention cash flow. Since it's a rate of return, we are taking the profit as an element. So average annual profit divided by initial investment. You can make a note of it in formula. Please write the formula. There are two formulas that are in usage. ARR can be calculated average annual profit divided by initial investment into 100, which will be expressed in percentage, or average annual profit divided by average investment. Average annual profit, how we are going to take it? Total profit divided by total profit over life divided by number of years. Whereas average investments, how will you take it? Initial investment plus salvage value. Okay, initial investment, how much you are making, and the salvage value, residual. At the end of the investment period, how much you are able to get a proceed out of that particular asset divided by 2. Yeah, one, if the ARR is greater than or equal to target rate of return, so you'll be accepting it. When ARR is less than target rate of return, that will be rejected. So target rate of return, say for example 10%, ARR is 15%, ARR is greater, that time you will accept. Target rate of return is 10%, whereas ARR is only 8%, you will be rejecting that project. I think hope you will understand very simple formula, average annual profit divided by initial investment into 100. Yes. Let me have a simple problem. Say for example, you have initial investment of rupees 5 lakh, salvage value 50,000, total profit over 5 years 3,40,000, and automatically the average annual profit, if you divide 3,40,000 divided by 5, which will be 68,000. You are requested to calculate accounting rate of return, ARR. So you can do it in two formulas. We mentioned about it two way. So based on initial investment, it's very simple. ARR is equal to average annual profit. So average annual profit is already given 68,000 against the initial investment of 5 lakh into 100. So you are able to get 13.6%. Let me try with the second formula based on average investment. See how we're going to do it. Average investment, initial investment plus the salvage value divided by 2. So 5 lakh is the original investment made, initial investment, plus 50,000 is the residual value. Salvage value is given. So divided by 2. So 2,75,000. ARR is 68,000, that is average annual profit divided by 2,75,000 into 100. So ARR 24.73%. See, if you calculate ARR with the initial investment 13.6%, you are able to get it, and ARR with average investment, that result in 24.73. Say for example, if the record rate, expected rate is 12%, now we are going to compare. So both method exceed 12%. So first one is more than 12, second one is also more than 12. So project generates accounting returns above the record rate. So you can accept the project since the profit is satisfactory. I think we'll get a clear idea from this accounting rate of return. I think hope you are also doing simultaneously along with me. So please don't cut short the calculations. You can do all the thing elaborate calculation as I mentioned in the slides. So let me consolidate all the thing. Let me go to the final slide. Let me consolidate all the thing. It is essential to compare all the methods under capital budgeting. We have certain criterion. One side it's mentioned, left side column it mentioned as criterion. So each column represent one value. Say for example, one method, payback period, discounted payback period, net present value, IRR, profitability index, accounting rate of return. If you look at the basic concept, time to recover initial investment, that will be calculated in payback period. Time to recover investment using discounted cash flow, that will be done under discounted payback period. And what is the difference between PV of inflow and initial investment, that will be calculated under NPV. And under IRR, the rate at which NPV is equal to 0. We'll go for a trial and error basis. And profitability index, yes, ratio of PV of inflow to initial investment. Good. I think accounting rate of return, average profit as percentage of investments. I think the formula and everything taken. I think accept and reject criteria when payback period is lesser than the target period. Otherwise, you can check in when the payback period is shorter, very shorter. We'll be choosing, and discounted cash flow also like that only. Net present value, it should be greater than 0. Okay, and IRR should be greater than the required rate, and whereas profitability index, that should be more than 1, and accounting rate of return ARR, that should be greater than or equal to target rate. I think this table will give you a complete information about the different methods of capital budgeting. Okay, what we have discussed for the last 30 minutes. Thank you for watching our YouTube channel at MBA Decoded 100. We are known for the subjects related to MBA, commerce, and economics. We request you to like, share, and subscribe. Thank you, and all the very best.